Hey, good morning, options traders. Well, this video is done to really serve a couple of purposes. One, because of the rough ending that we had last week after Thanksgiving, I've had a number of people asking about volatility strategies, and this is a volatility strategy. And then the second point is kind of a theme that I've been talking about lately, is that a lot of the more complex strategies that you hear about really aren't all that difficult once you learn to break strategies down. Most of these complex sounding strategies that you hear are probably just smaller strategies with just a very slight twist to them. And so it's to really show the new traders that don't get overwhelmed with these strategies. If you understand the basics in your options theory, they become very easy to break down. And the more strategies you have, the better your results will be. So we're going to look at one today called a wrangle. So what in the world is a wrangle? Well, a wrangle is one of many what are called volatility spreads. It's basically delta neutral, which means that however many deltas you've purchased are going to be roughly the number that you will sell. So a very common delta neutral strategy is things like straddles and strangles. Now, the wrangle can be viewed in a number of different ways. Again, that's one of the points of this video, is to show you different ways of looking at strategies. But one that is probably the most common is to see it as buying a put backspread and then buying a call backspread. So we've talked about backspreads in previous videos. You're just doing it twice, once on the call side, once on the put side. Now, they do have to have the same expiration. That's part of being a backspread. But for the wrangle, the short strikes are the same. So let's start by breaking this one down with the long call backspread. So for the long call backspread, you are going to sell, let's say, one of the $100 calls. And according to a pricing model that I used here, was trading for about 230. And then we will buy two of a higher strike. So maybe we buy two 105 calls. And according to that same pricing model, would be trading at about 65 cents each, or $1.30 total. Right? Because you're buying it twice. So now take a look at those two cash flows. You're collecting $2.30, you're spending $1.30. That would give you a nice round credit of $1. So notice the basic structure here. You are selling the more valuable call. Remember that lower strike calls, all things being equal, have to have more value. So you're selling, in this case, the 100, but you're buying higher strike calls beyond that. So it could be the 110 calls, the 115s. The strike doesn't matter so much as long as you are selling the more expensive strike. So for the calls will be the lower strike, and buying higher strikes. So if we did this strategy right here, sold the $100 call and bought two 105 calls for a net credit of $1, here is your risk graph. And you all know by now we get bends at the strike. So here's our short 100 call. So you can see if we sold that just by itself, if it were a naked call, we would come up this way and have unlimited potential losses. If we bought one of the 105s, we would flatten out. That would just be a vertical spread. But because we've bought two, we now have this right wing over here raised, and that's what's giving us these positive deltas. So this would normally be put on with the stock, in this example right here at 105, delta neutral. And if the stock price falls down here below 100, or the short strike, we do have our gain of the credit. So it's usually a very small gain, but at least it's some type of a gain if you're wrong. So we're basically looking for an explosive move to the upside, but the long call backspread is at least giving us a little bit of a safety net in case we're wrong in a really big way. Now, can we lose on this strategy? Of course. Right here in the middle, you can see where the strategy lies below zero. So in this instance, if you have a credit of $1, it's a 5-point difference in strikes. The maximum loss right over there would be $4. So that is a long call backspread. What's the other half of the wrangle? Well, that would be a long put backspread. Just the opposite. So using that same pricing model, let's say that we sell one $100 put, trading for about $2.30. We buy two of the 95 puts, 65 cents each, or about $1.30 total. Again, net credit of $1. So notice the structure here. You are selling a higher strike put. And all things being equal, higher strike puts have to be worth more money. So you're selling this expensive put, but buying two cheaper ones below it. So again, it doesn't really matter which strike. This could be the 95s, the 90s, the 85s, but it's going to be in this type of a structure. Selling a higher strike put and buying two lower strikes. So if you did this trade, sold one of the 100 puts, bought two of the 95s, net credit of $1, this would be your risk graph. So it's the same one that we saw for the calls, just moving in the opposite direction. Here is the short 100 put, and if you just shorted that put by itself, naked put, you would head off in this direction. You would have unlimited downside risk, at least down to a stock price of 0. If you purchased one of the 95 puts, you would flatten out. That would just be a vertical spread. But because you've purchased two, you now have these nice unlimited negative deltas off in this direction. So same idea. If the stock price happens to rise, you would at least have this small gain over here, the initial credit. But if it falls, you've got this potential for very big gains to the downside. So the Wrangle is just combining both of these spreads. You would buy the call back spread and you would buy the put back spread. And so if you did that, this becomes your risk graph. Kind of a strange looking risk graph, looks like a letter W. So here is the short strike in the center, the hundreds. And then over on this side are the puts that we saw. That's what's creating this left wing to be raised. And over here on the right is the 105 strike from the call, causing it to be raised. So kind of a neat thing about the Wrangle is that if the stock stays fairly neutral, which remember stocks do most of the time, especially over the short run, you will at least have some type of a gain. But if you get an explosive move to the upside or to the downside, you can then make unlimited profits. So you can see that the worst thing for the Wrangle to have happen is for the stock price to move a little bit to the upside, put you into this maximum loss down here, or to move down a little bit. You either want it to sit still or to make an explosive move up or down. So recall that the main point of this video isn't to get into all of the details of the Wrangle or even the backspreads for that matter, but instead is to show how easy it is to break strategies down once you understand the basics. So let's take a look at this. Let's look at an alternate view. Let's say that you sold one straddle. That's selling the call and the put with the same strike. But then you bought two wider strike strangles. So we sell the 100 straddle, we buy the 95 105 strangles. That would be buying the 95 put and buying the 105 call, but we're doing it twice. What's that going to do? Well, let's start with selling the 100 straddle. Again, that's short the 100 call and put. This is your risk graph. If we buy the 95 105 strangle once, this would be your risk graph. And what would that create? We've talked about this before. You're short a straddle, long a strangle. That is a butterfly. So notice that the butterfly has these flattened wings. We are flat if the stock price falls below this strike or if it rises above this strike. That's the butterfly. But if you buy the strangle twice, what happens? Well, now you have extra deltas on this wing. You've got an extra call over and above the butterfly. So that's just going to raise this right wing up this way. And because you've purchased the extra strangle, you've got an extra put down here. And that just raises these negative deltas out this way. And there is the W shape that we see with the Wrangle. So again, lots of ways to look at it. We could say it's a short straddle combined with two strangles. Or we could say it's a long call back spread combined with a long put back spread. Lots of different ways. And in fact, there are other ways to view it, and there are synthetic ways to view it. But part of what I'm trying to show you here is don't get so intimidated when you hear about all of these different strategies, and especially ones with complicated sounding names. Learn to break them down, and you'll see that they're probably strategies that you already know. And the more strategies you know, or the more ways that you know how to combine them, break them apart, morph them, roll them, the better your results will be. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.